Welcome to the Pro Ticker Deep Dive. Okay, let's unpack this puzzle that's really been dominating the market talk lately. If you're tracking the U.S. economy, it feels a bit like you're watching, I don't know, a detective story playing out in the data. We've got this strange divergence, almost paradoxical, in the labor market. One headline seems to shout, "Slow down, recession," while, the underlying currents are much calmer, suggesting resilience.
It really does create a kind of analytic whiplash for anyone trying to stay informed. The basic conflict is this. Non-farm payroll growth, yeah, it's decelerating sharply. Historically, that's a bad sign, means weakness. But then you dig into the full picture, the other employment metrics, the real health markers,
Does it look okay?
they're holding up surprisingly well. So for traders, for policymakers, really for anyone managing money, the big question is, which signal is telling the actual truth here?
Exactly. So our mission today is to, try and cut through that noise. We're going to dive deep into these sources and figure out which signals the softer headline NFP or those stronger undercurrents people should really be paying attention to. Because ultimately, the answer kind of dictates whether we're bracing for a hard economic landing or maybe cruising towards that elusive soft one. Let's start with the number causing the most anxiety. Non-farm payrolls, the NFP growth. Our sources show it's cooled off sharply since May. Recent reports, they're expected around a pretty modest 80,000 jobs added. Now, that's the soft signal, and like you said, historically, an 80K print. That's a huge red flag.
It's a red flag because, it barely keeps pace with population growth. It certainly doesn't signal strong expansion. If NFP really settles in around 80K consistently, that means we're adding slack to the system, not absorbing workers. However, and this is crucial, this is where that strong counter evidence comes in. If the economy were really just falling off a cliff.
We'd see it elsewhere, too.
Exactly. You wouldn't just see payrolls decline. You'd see this sort of cascading failure in other key indicators.
Right. And those indicators, they're still looking, pretty healthy, aren't they?
Yeah, surprisingly so. Take jobless claims. They're contained. We're not seeing mass layoffs lighting up the screens. And job openings, still hovering well above pre-pandemic levels. That suggests employers are either holding on to staff or, still struggling to fill positions, not panicking and cutting back massively. And maybe most importantly, the unemployment rate. Okay, it's edged up a little, but it's still historically low at 4.3%. That specific mix, soft NFP, but contained claims and still high openings that points towards a transition, not a collapse.
A transition implies a slowdown, sure, but maybe a managed one. How is the Federal Reserve reading the specific nuance in the data?
Yeah, the interpretation is absolutely key here. The thinking seems to be that a labor market is cooling, yes, but maybe to a sustainable pace. It's not entering some kind of death spiral. And this reading, it has immediate policy implications. The Fed seems to be leaning towards a pretty modest 25 basis point cut in October. That reflects the cooling. But importantly, all that market chatter demanding a big panic 50 basis point move.
That's fading.
That's fading fast because they're just not seeing the emergency signals in that broader mosaic of data to justify such a rapid, aggressive pivot.
Okay, that makes sense for the managed slowdown argument, but let's push on that a bit. If the labor market is slowing, even sustainably, where's the underlying strength coming from? What's keeping the whole U.S. economy afloat? Where's that resilience anchored?
Well, if we connect this jobs divergence to the wider picture, the anchor is overwhelmingly the U.S. consumer. We saw really stunning evidence of this just recently in the GDP revisions. U.S. GDP growth for Q2, it was revised significantly higher. It jumped from an already pretty solid 3.3% all the way up to 3.8% annualized.
Wow, okay, half a percentage point jump, that's actually massive at this scale. Did the source material give any clues on what drove that revision? Was it just, high-end spending, or was it more broad-based strength?
It was overwhelmingly driven by private consumption. And the details are interesting. The sources suggest this resilience comes from a few things lining up. First, there's evidence of pretty robust wage growth, particularly in lower wage sectors, which is finally giving people some cover against inflation. Second, those excess savings are dwindling, but they clearly sustained spending power for longer than many expected.
So the consumer is just still spending.
Still very much alive and kicking. It kind of defies those textbook predictions that higher interest rates should have choked off spending much sooner.
It's fascinating, isn't it, how different the U.S. story seems compared to, pretty much everywhere else right now. We have this consumer strength, but globally the picture looks much more uneven.
Yeah.
Manufacturing seems under pressure everywhere, but services, much like here, seem more resilient.
That global unevenness is exactly what makes the central bank maneuvering so incredibly tricky right now. Some good news for the Eurozone, though, is that inflation does seem to be easing. Headline is trending towards their 2% target, and core inflation is expected to dip to around 2.2%. That takes some pressure off, gives the European Central Bank a bit of breathing room to hold rates steady, rather than rushing into cuts and potentially reigniting demand too soon.
And we see other central banks doing this really intense balancing act too, right? Often specifically trying to protect their currencies from imported inflation.
Precisely. Look at the Riksbank in Sweden. They acknowledge their labor market recovery is slow. That's a soft signal, just like our NFP here. But they were very careful not to hint at easing anytime soon. They just can't afford to give up the inflation fight yet. Meanwhile, you've got the Norges Bank in Norway actively intervening in the currency markets. Daily sales in September averaged NOK 276 million.
Wait, that specific number, NOK 276 million a day, why is that figure significant for us, for the listener? What does it tell us?
It's significant because it shows the scale of the effort. It's quite an aggressive intervention level. It clearly signals they view currency stability as absolutely critical to their inflation fight. They're trying hard to manage the krone's volatility, and this global tightrope walk, trying to manage slow growth, alongside sticky prices and these volatile currencies, it actually reinforces the U.S. dollar's recent strength because other central banks just aren't rushing to ease as aggressively as the market might have thought a while back.
Okay, so let's tie this all together. We have this macro story. Resilient U.S. consumer, a slowing but not broken labor market, and this slower global easing path. How have markets, specifically rates and currencies, actually reacted to this slower easing narrative taking hold?
Well, we've definitely seen a spike in volatility in the bond market as expectations get reset. The two-year Treasury yield, which is, super sensitive to Fed policy expectations.
Yeah, it jumped up.
It climbed quite a bit, up to around 3.44%, and the benchmark 10-year yield is holding near 4.18%. What's really crucial for listeners, though, is how the market is now pricing future Fed cuts. We're seeing about 21 basis points priced in for the October meeting, rising to maybe 39 basis points by December. That is clearly a slower, more measured path than the really aggressive easing the market seemed positioned for just a few months ago. German bond yields also nudged higher, by the way, partly on sticky inflation data there, too.
And that reset in rate expectations means the dollar snapped back hard, didn't it? So much for everyone calling for the dollar's imminent demise just, 6 weeks ago?
Exactly. That stronger U.S. GDP number, plus the Fed basically refusing to commit to panic cuts, it gave the dollar new legs, solid footing. We saw USD pull back quite sharply, down towards 1.1650. It tells us that the sort of easy dollar short trade narrative, that's over. For now, anyway. Currency moves are becoming much more data-dependent again, waiting on the next inflation or jobs print. Even pairs like USD and OK jump back over 10.00, reflecting that dollar resilience against this backdrop of uneven global growth.
What about equities, then? If rate cuts are coming slower than hoped, shouldn't stocks be, more worried?
U.S. equities did pull back a bit from their recent highs. Sure, that happened when the Fed didn't signal the really rapid easing some had hoped for. But, let's keep some perspective here. The S&P 500 is still up double digits for the year. Investors don't seem to be panicking about a deep recession. It feels more like they're adjusting expectations, adjusting to a world where rate cuts might arrive more slowly, but importantly, where the economic engine isn't completely stalling out, sort of a Goldilocks adjustment.
Okay, this brings us nicely to the future outlook, which is always what listeners want to know. We've kind of laid out two main potential paths here. That Goldilocks scenario where everything cools down just right, and then the major downside risk, the things that could signal a real collapse. Let's start with the upside, the Goldilocks opportunity.
Right, the Goldilocks scenario, it's really built on this idea of moderate cooling. If NFP growth sort of stabilizes in that, let's call it a sweet spot, maybe 80,000 to 100,000 jobs per month, and importantly, the unemployment rate holds fairly steady, then the Fed basically achieves its goal. It can ease policy modestly without triggering widespread recession fears. And that setup, well, that's generally quite bullish for risk assets, for stocks.
But wait, just to push back slightly, if NFP really does slow to 80K, isn't that just history repeating itself? We've seen slowdowns start like this before, near recessions that ended up needing massive cuts. How is this slowdown potentially different?
That's a fair question. I think it's different because of the underlying structure supporting consumption right now. In many previous cycles, a slowdown like this was often preceded by, say, wage growth falling off a cliff or a major collapse in housing. This time, that consumption pillar seems reinforced by Pretty steady wage growth, still running around 0.3% month over month, according to the sources. And also, remember the ISM Services Index. It bounced quite sharply in August.
Ah, right. Services momentum.
Exactly. Services demand is the bulk of the U.S. economy, and that momentum is helping support risk sentiment. It suggests this slowing NFP might be more about normalization, getting back to a sustainable pace, rather than, outright decay setting in.
Okay, that helps clarify the distinction, but we absolutely have to acknowledge the downside risks. What's the number one thing listeners should watch for? What could really blow up this Goldilocks view?
The biggest risk, I think, is a really nasty payroll surprise. Like a number coming in below 50,000 jobs added. That would instantly shift the market narrative back towards aggressive recession fears. The Fed would almost certainly be forced to reconsider much bigger, faster rate cuts. Second big risk, sticky inflation, particularly in services. If those costs keep core inflation stubbornly above, say, 2.5%, central banks globally, not just the Fed, might be forced to keep rates painfully restrictive for longer than expected, which could eventually strangle growth.
Makes sense.
And finally, don't discount global trade tensions. Things like tariffs on intermediate goods, steel, aluminum, they continue to pressure manufacturing costs, which can keep overall prices stickier even if demand is weakening.
Got it. Okay, let's shift gears slightly and look at the technical picture. For listeners who are focused on shorter-term moves, what specific levels were highlighted in the material?
Sure. Starting with U.S. equities, specifically looking at S&P 500 futures, the technical support level seems to be holding near 6,500. Resistance is seen just above 6,700. Momentum indicators currently suggest there might be room for a bit more of a pullback, maybe testing back towards that 6,500 support before potentially finding footing for the next leg higher. We're not seeing signs of a major breakdown just yet on the charts.
And in the bond market, that 10-year yield feels like the key psychological level everyone's watching right now.
Absolutely. The 10-year yield seems to have formed a pretty critical base near 4.10%. The resistance level is quite clearly defined up at 4.25%. And we need to understand the significance of that 4.25% level. If we were to see a decisive break above that, it would really challenge the whole soft landing narrative, because it implies the market thinks restrictive financial conditions will stick around, which would severely impact things like housing and long-term investment decisions.
Right, and for USD?
For USD, the key levels seem to be resistance around 1.1750 and pretty crucial support down at 1.160.
Okay, so pulling that technical picture together with the economic backdrop we've discussed, the near-term trading setup seems focused on navigating this soft but not scary data flow, doesn't it?
Exactly right. The setup looks like this. Potentially buying dips in equities if the labor data continues to land in that soft but not scary zone. You probably expect near-term dollar strength to maybe extend a bit further given the Fed's reluctance to panic and that global central bank balancing act we talked about. But the medium-term path, both the dollar and for rates, still hinges almost entirely on those sticky services inflation prints. That's the real decider going forward.
So the final synthesis here really is that the dominant market story is divergence, not outright collapse. You've got payrolls flashing a yellow warning light, but the broader U.S. economy, thanks largely to that surprisingly resilient consumer and steady wages, seems to be cooling in a more controlled fashion. And that overall environment, for now at least, seems generally supportive for risk assets. So the key takeaway for you, our listener, is probably this. Try not to get whipsawed by every single headline print. Don't obsess over just one NFP number in isolation. Instead, you really need to watch the broader mosaic, as we've called it, wages, job openings, what's happening with services demand, and those core inflation measures. That broader, more holistic view is what truly determines if this payroll softness signals dangerous weakness or if it's just a successful managed shift towards a more sustainable growth rate.
And that leads to maybe a final provocative thought that goes beyond just the next few months. If this broader mosaic does hold up, if the consumer stays resilient and inflation continues to cooperate, even slowly, then the economy might be slowing down just enough to actually extend this economic cycle for much longer than many bears currently predict. So what are the longer-term sort of structural implications for how you allocate capital for investment strategies in a world that might be defined not by boom and bust, but by a managed long slowdown? Something to think about.
See you all in the next Pro Ticker Deep Dive.